All right, today we're going to pull back the curtain on this massive and, let's be honest, often invisible part of the global financial system. We're talking about a world that affects pretty much everything, from your pension to the stability of entire countries. So let's dive in and figure out how it all works.
Okay, just look at this number $218 trillion. I mean, let that sink in for a second. That is almost half of all the financial assets on the entire planet. It's a figure that's so vast, it's kind of hard to even wrap your head around, right? So that's the size of what we call the non-bank financial world. And that brings us to the big questions. What exactly is it? And why should you even care? Because this isn't just some abstract number on a screen. No, it represents a massive shift in how money, credit, and, yeah, risk move around the globe. And believe me, understanding this is absolutely key to understanding finance today. All right, let's get into it. Finance's hidden trillions. First things first, we need to define what we're actually talking about here.
So, we're talking about non-bank financial institutions, or NBFIs for short. Now, you know what a regular bank is, right? You put your money in, they give out loans. Simple. Well, NBFIs do a lot of the same stuff, especially providing credit, but they operate outside of that traditional, heavily regulated system. For a while, people called it shadow banking, which sounds a little dramatic, but it really gets at how murky and hard to see this part of the financial world can be.
And who are these players? Well, you're gonna recognize these names. We're talking about huge investment funds, the insurance companies that hold our policies, and yeah, the pension funds that are managing retirement savings for millions and millions of us. All of them together form this vast ecosystem, and each one brings its own special brand of risk to the table. Okay, so how on earth did this parallel financial universe get so enormous? I mean, this didn't just happen overnight. It's really the result of a massive shift that's been going on for the last decade or so.
It really comes down to three big things. First, after the 2008 crisis, we had this decade of super low interest rates. So investors were all looking for better returns, right? And they found them in market-based investments. Second, the banks themselves got hit with a ton of new, stricter regulations, which made it harder for them to lend. So what happened? All that lending activity got pushed over to the non-bank sector. And third, you've got technology. Things like fintech platforms and ETFs made it way cheaper and easier for everybody to get in on the action. The bottom line is credit basically packed its bags and moved from the banks to the markets.
Now, this new system is definitely more flexible, more diverse, but it's also created a completely new way for risk to build up and spread. So let's pop the hood and take a look at the hidden risk engine that powers this whole thing. Okay, the first big vulnerability is something called liquidity mismatch. Here's the simple version. It's when a fund uses money it might have to pay back tomorrow to buy an asset it can't sell for a month or maybe even longer. So what happens if all its investors suddenly get spooked and demand their cash back all at once? The fund is totally stuck. It's first to sell those long-term assets at rock-bottom prices, and that can cause a major crash. Next up, we have leverage. You've probably heard this term. It's basically using borrowed money to make bigger bets. And hey, when things are going up, it's fantastic. It juices your returns. But it also magnifies your losses. It can turn a small dip into an absolute disaster. And what's really sneaky here is something called synthetic leverage. This is leverage that's created using these complex financial contracts called derivatives, and it can totally hide just how much risk a company has actually taken on.
And finally, number three, interconnectedness. You know, that term non-bank is actually a little misleading because the truth is these institutions are deeply, deeply tangled up with the traditional banking system. We're talking about a super complex web of funding, collateral, and derivatives. And what that means is that a problem in one tiny corner can spread like a virus through the entire network. Now, here's where it gets really crucial. These three risks, liquidity mismatch, leverage, and interconnectedness, they don't just exist in isolation. Oh no. They feed on each other. And this diagram shows it perfectly. It's called the NBFI transmission loop. Think about it. A liquidity crunch can trigger a margin call on a leveraged bet. That forces asset sales, which then spreads stress through the whole interconnected system, which then causes more liquidity problems. It's a vicious, accelerating feedback loop. Yeah, this is really the hidden plumbing of the entire modern financial system. A shock doesn't just stay put. A problem at a pension fund in one country can, in an instant, become a massive headache for a big investment bank on the other side of the world. Why? Because they're all connected in what is basically one giant global pool of liquidity. And look, this is not just some academic theory. We have seen this hidden risk engine roar to life, not once, but twice in just the last few years, pushing the global financial system right to the edge of a cliff.
Let's talk about two key examples. First, you have the March 2020 Dash for Cash. That was a global panic, a liquidity shock. Then, just 2 years later, you have the UK LDI crisis, which nearly took down the entire British pension system. That was a concentrated leverage shock. See the difference? Totally different triggers, but exactly the same underlying problems.
So back in March 2020, when the pandemic first hit, everybody everywhere wanted cash, all at the same time. This set off what are called margin calls, basically demands for more cash to back up borrowed positions. This forced all these big funds to sell their best assets, even super safe things like US Treasuries, just to raise money. But all that selling pushed prices down even further, which then triggered, you guessed it, even more margin calls. It was a textbook terrifying feedback loop. And then it happened again in 2022. A surprise announcement from the UK government caused a sudden spike in their bond yields. This slammed UK pension funds with enormous margin calls on all their leveraged hedges. So what did they have to do? They were forced to sell their UK government bonds to raise cash. And that, of course, pushed yields even higher and created, another one of those vicious feedback loops that almost brought the whole system down. And here's the absolute kicker. In both of these crises, central banks had to ride to the rescue. But as the Bank of England pointed out, and this is so important, they weren't just saving banks anymore. They were acting as a lender of last resort for the markets themselves. That is a massive paradigm shift. It's the proof that the biggest risks to the whole system now live way outside the walls of traditional banks. Which brings us to the final, and maybe the most critical question of all. How in the world do you police the shadows? How do you regulate a system this big, this complicated, and this interconnected? Well, it's a huge headache for regulators, for a few big reasons. First, these shocks are global. They spread through balance sheets in a split second, which means one country's policies can't really contain them. Second, a lot of it is just opaque. You've got offshore centers that can hide who owns what and how much leverage is really in the system. And finally, unlike the banks, which have this unified global rulebook, there's just nothing like that for this sprawling world of NBFIs. So what's the answer? Well, the experts are starting to agree that we need a whole new approach, something they call a meta layer of governance. Basically, it means we have to stop looking at banks and non-banks as separate things and start looking at the entire system, banks, NBFIs, the whole plumbing that connects them, as one single thing that needs to be supervised. It means regulators have to break down their old silos and start working together. And that really leaves us with this final, lingering question. The financial world has completely changed. The big, scary risks aren't just sitting in the banks anymore, where we've all been trained to look for them. So the real question is, can our ability to see and manage these new risks evolve just as fast? As this world keeps growing beyond traditional banks, can regulators ever really get ahead of the next crisis? Or are we always going to be one step behind?